Okay, hi everybody. It's Lenny Hayes here. Um, Welcome to this sharing. We're just going to go through and recap a little bit of the week that was. Last week of April, month end, historically during month end, we can start to get some unusual moves and a lot of repositioning and rebalancing flows across asset classes, which can lead to some unusual moves and sort of unpredictable and unjustifiable um, price action. But so we'll start from the top. Data-wise, there wasn't a great deal out of the US, and there was a little bit in Australia, and we had some Japanese central bank central bank activity. So in the back end of the week, we had a double whammy of data on Thursday night. We had the US GDP data. We've got the GDP here, and we've got the PCE index. So what we saw here was we saw the PCE, which is the inflationary aspect, which the Fed likes to look at, so the core prices. So it actually came in hotter than expected over the 4.7% forecast, which isn't at all promising. As you can see here, we're sort of yet to see any meaningful downturn in this index. It's still been hovering around that persistent 4.5% level. And on top of that, we saw GDP come in, which was quite a lot lower than the surveyed estimate of 1.9%. Still not recessionary by all means, but not as prosperous as economists were forecasting. So with all that said, that isolated mix of data does point to a stagflationary environment, which is a deadly mix, and it's not very promising. I mean, you've got prices still rising while economic growth is deteriorating. So that's not positive for anything. Whether it's just an isolated incident, there's a lot of lagging factors behind it. We're yet to see. But that said, coming out Thursday night, and we saw stocks, especially on Thursday night, rally in the S&P 500. I mean, they've had a pretty good week. They've advanced on the week and hit new monthly highs and yearly, for that matter. So a lot of it's got to do with some pretty good earnings results. We saw Amazon come out, which was quite impressive, and we've seen more of the broader indices around the world perform quite strongly, which is probably still a byproduct of some of the slowing employment numbers and some inflationary reads we've been seeing out of the US. But I keep reiterating that they're not out of the woods yet, and we have data events like the PCE index still remaining persistent. It's a little bit hard to make sense of stocks that are rallying so successfully. And we've got to remember that a lot of these earnings results are off the back of forecast revisions to the downside. And I mean, it's the easy beats, really. So look, that's the what we've seen there. In the wake of all this, we've seen First Republic go on another sell-off there over the last few days, as that stock is teetering on the edge. We've seen some disastrous performances after that initial sell-off back in March, and it looks like there's uncertain times ahead for that particular stock. But I mean, with the banking crisis that we saw back in March, we see these issues spark again with liquidity problems and deposit outflows. We really didn't see any fear be struck across the market as First Republic started to falter again. So just interesting to note that. Okay, so in Australia, we can have a look. Just another data read that came out of Australia during the week. look at it here. So the quarterly CPI print came out, and it was surprised to the down. Well, it was mixed actually. So the big component was the core read. So the latest is still 7% headline, which was in line with RBA forecast and a little bit over economists' forecasts. But the core reading, mean CPI. So the core reading, which is the important one, came in under forecasts. So yeah, it was 1.2%, and the survey was, I believe, 1.4. So all that said, it's likely that the RBA, who has their meeting on Tuesday this week, the 2nd of May, will likely keep their policy rate on hold again, making it the second straight month of doing so at 3.6%. And yeah, I mean, we saw the Aussie dollar impacted by that. We can look at the more of a short-term view, but yeah, I mean, without the prospect of rate hikes, Aussie dollar's been slipping quite drastically. It's sitting a little bit above 65 cents, but you know, the last sort of month it's been pretty rocky for the Aussie dollar. It's topped out at just under 68, and since then it's trended down nicely. This range bound period sort of represented a bit of a flag there after this initial downtrend, and it's consolidated and flagged, and then around here it's broken out to the downside. So the fundamentals make sense there. Commodity prices have been flailing. Iron ore's been smashed. Oil's given away all the gains saw after the OPEC announcement. Copper performing very badly. And yeah, I mean, it makes sense with the rates differential that the Australian dollar poses. That, yeah, it seems fair value down here, and yeah, it wouldn't be astray to see 64 to 63 handle at some stage later in the year. And then what we saw on Friday was the Bank of Japan. Now, Bank of Japan is notoriously volatile, and I mean, the way they announce their policies, it's not a set time. It comes out within a 2 to 3 hour time frame. You don't know when it's coming, and the policy they have in place now is extremely loose compared to the rest of the world. And they've got a new governor in, Ueda. So anyway, the world was keenly awaiting on Friday to see what they come out with. In the end, the policy was unchanged. They were scrapping forward guidance and still promoting flexibility, but wanted to keep monetary policy loose and promote further growth and further inflationary promotion. So the yen on the day, I'll just show you the range and the price action. It was quite remarkable, really. We saw it chop and change around everywhere. But yeah, so this was the initial price action. You can see here, this is when the news came out, quick spike, and then yeah, it's continued climbing up to 136 all the way to the close there. So it's a record high against the euro, and it's back up to pretty weak levels there for the yen after a consolidated strongly earlier in the year. So yeah, look, on the event front, that's all that was really there. On the Asian indices, another positive month for April, finishing the week strong with really good gains on the last day of trading. Not quite the same can be said for the Hang Seng. However, there's still pretty good ranges and quite a strong level there. It did reach those record highs in January, which was after the reopening story really developed. But since then, it's retraced a little bit, but yeah, I'd look for it to continue bumping up higher. Treasury yields, a little bit of a trend there. We saw it break out to the top side, but since then, it's still trending lower. Look, a case could be made for a flag pattern forming, and we could break out again to the top side. I think the Fed's going to hike one more time. They don't meet for a while yet, but yeah, I think it's probably plausible to think that they'll still hike. The data is indicating that there are pretty strong employment conditions out there still, and the PCE on Friday did show that prices are still pretty resilient. So yeah, look, I'd say that it's not going to be unlikely to see the 3-year yield back above 4%. I think that's probably going to be on the agenda at some stage. I think at these levels, it's just a little bit too low, the yield, unless we get a risk-off event and another banking crisis spurred on by the First Republic issue. Then, yeah, I think this yield could probably jump up a bit higher. All right, well, that's the month done, April. Into May now, the year's flying past. Yeah, and then pretty subdued sort of week. Yet to see pretty violent moves since that March event. But yeah, we're just ticking away. Volatility's been really low across currencies. The VIX is extremely low. So yeah, there's calm. There's a lot of calm. But yeah, it just shows a little bit of indecision, and no one's really ready to make too much of a bold call or move yet. All right, thank you for tuning in, and we'll be back in touch later.